Goldman Sachs has just released one of its largest outlook reports ever, with more than 100 pages of charts, analysis, and forecasts for 2026 and the years beyond. Within hours, headlines began spreading everywhere claiming Goldman was predicting a market crash. Financial creators rushed out panic videos with dramatic thumbnails. Comment sections filled with fear. There is only one problem. That is not what the report actually says. I spent the last week reading through the entire thing, checking every page, cross-referencing the data, and separating what Goldman really expects from what clickbait creators want you to think they expect. What I found is much more balanced, and honestly much more useful than either the doom crowd or the endless optimists want to admit. Goldman Sachs is not forecasting a 2026 collapse. They are forecasting something that may actually be harder for most investors to deal with. It is something that calls for a very different approach from the one that worked over the last 15 years. Today, I am going to walk you through what the report actually says, the risks Goldman focuses on that most coverage ignores, and what all of this really means for your money in 2026 and over the decade ahead. Let me start with Goldman's actual view for 2026. The report is titled U.S. Resilience Resilient, and that title matters. This is not a panic report. It is a report arguing that, even with meaningful risks in the background, the American economy and stock market have proven remarkably durable and probably still will. Goldman's headline forecast for the S&P 500 in 2026 is a 7% return. Not a crash, not flat, a 7% gain. Here is how they get there. Goldman expects about 11% growth from earnings and dividends combined. U.S. companies are still producing strong profits. The AI infrastructure build-out is still driving heavy spending. Consumer spending remains healthy. All of those fundamentals support solid growth in the value of American businesses. But Goldman then subtracts 4 percentage points from that 11% because they expect valuations to compress. Stocks are expensive right now, and Goldman thinks some of that premium will gradually come out in 2026 as price-to-earnings ratios normalize. So 11% of fundamental growth minus 4% of valuation compression leaves them with a 7% base case for the year. That is below the long-term average, but still clearly positive. It is not the huge upside of 2023 or 2024, but it is nowhere near the crash headlines are pushing. Goldman also estimates recession risk at around 25%, which means they see a 75% chance of continued expansion. That is not trivial risk, but it is nowhere close to a certainty of collapse. So why are so many people acting like Goldman is warning of disaster? The answer is that they are mixing this report up with a different Goldman forecast from several months earlier. Back in October 2024, Goldman published a long-term outlook saying the S&P 500 might return only 3% annually over the next decade. That number grabbed attention immediately and still fuels crash narratives today. But most coverage leaves out the context. That 3% estimate was specifically for the S&P 500 and was based on worries about concentration and high valuations. Goldman's global equity forecast was actually higher at 7.7% per year. And even their pessimistic U.S. projection was still a forecast of weaker returns, not negative returns. More importantly, Goldman explicitly says that low expected returns do not automatically mean a crash is coming. Markets can stay expensive for a very long time and still produce gains. The move from expensive to fairly valued does not require a collapse. It can happen slowly through years of earnings catching up to prices. Goldman's own data makes this point very clearly. The report includes a fascinating chart showing how markets have performed when starting from different valuation levels. They divide history into valuation deciles based on how expensive stocks were at the time. In the 1990s, the market moved into the 9th decile of valuations, meaning stocks were pricier than 90% of historical observations. What happened next? The market still climbed another 342% before the eventual correction. Then in 2015 through 2017, valuations again reached the 9th and 10th deciles. The expectation would have been weak future returns. Instead, the market went on to gain 200%. After COVID, Even though valuations were still in the ninth decile, the market gained another 100%. Goldman's own numbers show that expensive markets can remain expensive and keep going for years. High valuations are a risk factor, not a crash trigger. No one knows when, or even if, valuations will return to historical norms. That does not mean valuation does not matter. Over very long horizons, starting valuations are strongly linked to future returns. But the key phrase is very long horizons. Trying to time a correction using valuation alone has been a losing game for decades. Now let us talk about the valuation concerns that are real, because they absolutely do exist. The cyclically adjusted price-to-earnings ratio, or CAPE, is now around 39 to 40. For context, the historical average is about 17. That means we are more than double the long-term norm. This is only the second time in 155 years that CAPE has gone above 40. The only previous time was the dot-com bubble in 1999 and 2000. That comparison understandably alarms people. The dot-com crash wiped out trillions in wealth and took 13 years to recover from peak to peak. But Goldman argues that a direct comparison is too simple for several reasons. First, the composition of the index has changed massively. Today's largest companies are highly profitable, cash-generating businesses with strong balance sheets and real competitive advantages. The dot-com leaders were often unprofitable companies priced on hope rather than fundamentals. Second, profit margins are structurally higher today. U.S. companies now tend to generate margins above historical averages, partly because the market has shifted toward asset-light technology businesses. Higher margins can justify higher valuations. Third, interest rates matter. When bonds yield almost nothing, stocks deserve a higher valuation because they are the only meaningful source of return. Rates have moved up from zero, but when you compare them with inflation, they are still not at old historical norms. Goldman's view is nuanced. Valuations are a headwind for future returns, but they are not the dominant force. They expect valuation multiples to compress gradually and take some of the return away, but not through a sudden crash. One of the bigger concerns Goldman highlights is market concentration, and this is where their report becomes more interesting than most people realize. The top 10 stocks in the S&P 500 now make up more than 40% of the index. That is the highest concentration level ever recorded, even above the dot-com peak. Think about what that means in practice. If you own an S&P 500 index fund, 40 cents of every dollar you invest is sitting in just 10 companies. The other 490 companies split the remaining 60 cents. The Magnificent Seven alone account for around 35% of the index. Nvidia by itself is close to 7%. Goldman's research shows that historically, very high concentration has been a reliable sign of lower future returns and higher volatility. When an index is dominated by a small number of names, the whole thing becomes dependent on those companies rather than the broader economy. The issue is not that these businesses are bad. They are excellent businesses. The issue is fragility. If something goes wrong with a few of the biggest names, the effect spreads through portfolios that investors think are diversified. Imagine AI spending disappointing expectations. The giant infrastructure builders make up a huge part of the index. A shift in sentiment around AI could pull the whole market lower, even if most companies are fine. Goldman's point is that concentration does not cause crashes by itself, but it magnifies whatever comes next, good or bad. In a concentrated market, moves are more violent in both directions. That is one reason Goldman says the equal weight S&P 500 could outperform the standard index over the next decade. Removing the concentration effect may produce better risk-adjusted returns, even if the biggest companies keep doing well. Goldman also identifies a few other important risks in the report. One major issue is U.S. government debt. The debt-to-GDP ratio keeps rising, and Goldman does not see a meaningful reversal in the forecast. They outline possible ways to deal with it, like tax increases, spending cuts, or entitlement reform, but they do not think those fixes are likely to happen. Rising debt creates several risks. Interest payments take up more of the budget. Treasury issuance competes with corporate borrowing. At some point, investors could demand higher yields to hold U.S. debt, which would push rates up across the economy. Goldman is not predicting a debt crisis right now. They are treating debt as a long-running background risk that could matter a lot if some trigger causes investors to rethink U.S. creditworthiness. The second major risk is China, especially around supply chains. Goldman points out that China controls nearly 70% of rare earth mining, 92% of rare earth refining, and 94% of global magnet production. Those materials are essential for electronics, electric vehicles, and defense systems. On top of that, pharmaceutical supply chains still depend heavily on Chinese inputs. That creates vulnerability, and that vulnerability has already shown up in trade tension. It could get worse. The third major risk is monetary policy uncertainty. Goldman describes the environment as mixed monetary policy, with central banks around the world moving in different directions. The Federal Reserve has started cutting rates, but the path ahead is still unclear. Some Fed officials expect more cuts. Others think rates will stay steady. That uncertainty creates volatility risk. Markets have become used to the idea that the Fed will step in and rescue them when things go wrong. If inflation prevents the Fed from cutting during a slowdown, that assumption gets challenged. The fourth major risk is what Goldman calls localized vulnerabilities around the world. Political instability in specific regions, stress in certain banking systems, and real estate problems in some markets could create contagion even if the U.S. stays healthy. What I found most useful in Goldman's report is not the forecast itself, but their investment philosophy section. They lay out 5 pillars: history as a useful guide, proper diversification, a value-oriented approach, an appropriate time horizon, and consistency. All of that sits on the foundation of asset allocation. What struck me is how boring it sounds compared with the excitement of crash calls and moonshot predictions. But this is the framework used by one of the most sophisticated research teams in the world. They also include a chart showing the cost of missing the best days in the market. Since March 2009, staying fully invested would have produced nearly 17% annual returns. Missing just the 10 best days cuts that to 12%. Missing the 25 best days cuts returns in half. Those best days often happen during the scariest moments, when investors are most tempted to sell. The person who panicked during COVID missed some of the strongest days in market history. The person who sold during the 2022 decline missed the rebound that followed. Goldman's message is pretty clear. Trying to time crashes destroys more wealth than the crashes themselves. Being wrong about when a crash happens costs more than simply staying invested through volatility. So what does Goldman's report actually mean for different types of investors? If you are a long-term investor with 20 or more years ahead of you, the message is simple. Stay invested. Do not try to guess corrections. Accept that the next decade will probably produce lower returns than the last one, but still positive returns. Consider diversifying beyond U.S. large-cap stocks so you are not overly exposed to one part of the market. If your horizon is more like 7 to 15 years, Goldman's warnings matter more. A decade of 6% to 7% returns instead of 13% changes the math a lot. Your portfolio may grow much more slowly than you expected. You should update your projections, consider saving more, working longer, or revising your goals. If retirement is within 5 years, Goldman's concentration warning matters a lot. A portfolio that is heavily exposed to the S&P 500 is really a concentrated bet on a handful of companies. You should decide whether that level of concentration matches your risk tolerance at this stage of life. If you are already retired and drawing from your portfolio, Goldman's forecast of lower but still positive returns is not especially alarming. Sequence of returns risk still exists, but Goldman is not forecasting the kind of severe crash that would make that risk much worse. Here is what I personally take from the report. First, I am not changing my long-term strategy based on valuation concerns alone. Goldman's own data shows that expensive markets can stay expensive for a long time and still go up. The cost of waiting in cash for a crash has historically been worse than the cost of simply riding through corrections. Second, I am paying more attention to concentration. Having 40% of the index in 10 stocks is a real concern, not because those companies are poor businesses, but because it creates correlated risk. I would rather spread out more into equal weight strategies and international markets. Third, I am mentally extending my time horizon. If the next decade produces 6% to 7% annual returns instead of the stronger numbers we got recently, I need to adjust expectations. That is still compounding, just slower compounding. Fourth, I am keeping a larger cash reserve than I might in a cheaper market environment. Not because I am trying to call a crash, but because liquidity during volatile periods gives you flexibility to rebalance instead of being forced to sell. Fifth, I am ignoring the crash headlines. Goldman's actual forecast is for growth with elevated risks. That is not the same thing as a collapse. I am not going to make dramatic moves based on bad summaries of what serious analysts are actually saying. The crash prediction industry runs on fear, and fear gets clicks. A headline that says Goldman sees 7% returns will not go viral. A headline that says Goldman warns of a crash absolutely will. Financial media has a built-in incentive to exaggerate the scariest interpretation possible. That creates a gap between what analysts actually say and what headlines claim they said. Goldman's report is cautiously optimistic with a serious risk analysis. The headlines make it sound like they are calling for financial Armageddon. I have seen this pattern for years. Every serious research report gets run through an amplification machine that pulls out the most dramatic version. People who only read headlines end up with a distorted view of what professionals actually believe. The answer is not to ignore risk. The risks Goldman points out are real. Valuations are elevated. Concentration is extreme. Debt is rising. Geopolitical tensions are still there. The answer is to understand those risks in context. They are forces that can reduce expected returns and increase volatility. They are not the same thing as predicting an immediate crash. That distinction matters a lot for how you should respond. When I read a report like Goldman's, I use a simple framework. First, I try to read the original source whenever I can instead of relying on summaries. Goldman's real report is online, and the full 100 pages contain much more nuance than any clip or headline can capture. Second, I separate base cases from risk cases. Goldman's base case is 7% returns with a 25% chance of recession. Their risk case is worse. A lot of coverage presents the risk case as if it were the main one. Third, I think about incentives. Goldman benefits when clients stay invested and assets grow, so they are not incentivized to fake optimism. When they raise concerns, those concerns are worth taking seriously, but they also have no incentive to create panic. Fourth, I focus on actions, not just predictions. What is Goldman actually recommending? Stay invested, diversify, extend your time horizon, accept lower expected returns. They are not telling people to panic sell or completely reshuffle everything. Fifth, I remember that all forecasts are probabilities, not certainties. Goldman is not saying 7% will definitely happen. They are saying it is their best estimate based on the information they have now. Real returns will probably be different and may be very different. The most important insight in the whole report to me is the chart showing cumulative returns since Goldman's 2021 outlook. Since then, the US market has nearly doubled, up 99%. Developed markets outside the US returned about 60%. Emerging markets returned 24%. China actually fell 14%. 5 years ago, Goldman could not have predicted COVID, inflation, the war in Ukraine, the AI boom, or the many other events that shaped those returns. But the basic strategy of staying invested and staying diversified still worked extremely well, even with all that uncertainty. The next 5 years will bring surprises nobody sees coming right now. Some of them will help investors. Some will hurt them. Nobody knows exactly what they will be. What Goldman does know is that over long periods, owning productive assets and staying invested has built wealth more reliably than trying to guess when disasters will strike. That is not really a prediction about 2026. It is a lesson about how wealth building actually works. The investors who look back 5 years from now and regret their decisions are probably the ones listening to crash content today and getting ready to make emotional moves they will later wish they had not made. The investors who look back with satisfaction are probably the ones reading carefully, paying attention to nuance, and sticking to a long-term plan. Goldman's report does not guarantee the market will rise. It says that despite real risks, the base case is still positive growth, and the best strategy is still consistent investing. That is less exciting than crash predictions. It does not trigger the same adrenaline, but it is closer to what the best analysts actually believe and closer to how they actually tell people to position themselves. Which story you follow is up to you. Just make sure you understand what Goldman actually said before you decide how to act.